Hey guys, welcome to another episode with me, Shashank Udupa. And in this episode, we're going to talk about this very important key financial term known as inflation. Now, what is inflation? Right? Let me tell you it in a very simple format. What is inflation? When too much money chases a particular good, right, it leads to an inflation, right? If I have to put it in a slightly different way, inflation basically means an increase in the price of goods or services over a period of time, which devalues the purchasing power of money and currency. Right? Don't worry, I'll explain it more simply with simple terms and with more examples. Now, what do I mean by, inflation means increase of price of goods and services over time, which devalues the purchasing power of money. Now, you might have heard us saying that a lot of our parents keep telling that, at one point we could buy a particular commodity or we could buy something like a samosa for like 2 rupees or 3 rupees. But now you might need to spend around 10 to 15 or 20 rupees for it. So that basically does not mean that the goods and services have actually become very expensive. It also means that the money or the purchasing power of our currency has devalued, right? So the price of goods and services also have gone up and the price of the purchasing power of our currency has also gone down, and that leads to inflation. Now, to understand this in a more simple term, inflation, there are two types of inflation. The two types of inflation are demand pull inflation and cost push inflation. Now, let me explain both in very simple terms. Now, the first thing is demand pull inflation. Now, demand pull inflation occurs when there is an increase in supply of money and credit in the market. If there is more supply of money and credit in the market, it stimulates obviously more demand for a lot of goods and services in the economy, and that will make the inflation go up automatically. Why? Because there is increased demand and that leads to price rise. The production capacity might not be so much, right? But the demand is higher. Now, when does this happen? Now, for example, let's say that, we want to grow the economy and, we print a lot of money What happens is more liquidity in the hands of common man. Now, what happens is if I want to buy a particular product and you also want to buy a particular product, both are willing to pay the same amount for a particular product. That means the demand for that product is high, but the product capacity is the same. It's not going up, right? There's only 100 of that product, but there are 1,000 people who want to buy it. So what happened? Automatically, the price goes up of the commodity. So that is like an inflation by demand. So if there's too much demand, right, and there's too much liquidity in the country, and there is too much demand that is coming out of this liquidity for a same type of product where the production capacity is the same, the price usually tends to go up due to inflation. Number one. The second thing is cost push inflation. Now, this has nothing to do with the demand, right? Cost push inflation basically means the increase of prices when prices increase, but they increase in the production process of a particular company, right? When the company is trying to produce a particular commodity or trying to produce something, and suddenly in the production cost, something has gone up because of inflation. And obviously, if the cost of production goes up, the end cost of that particular product will fall on consumers, and then we have to pay extra for a particular product, right? And that is not because of demand. It's not because a lot of people want that particular demand. It's because maybe some raw materials have increased in the production process because of inflation, and that is why it has been pushed out in the finished product. So that is called cost push inflation. Now, these are the two things that are there with respect to inflation. Let me make it more simple and let me try to explain it in a more simplistic format. Just have a look at this image. Now, if you look at the first one, which is the blue one, which is more demand pull inflation, if you look at rising property prices are because increased consumer wealth. Increased consumer wealth means common people have more money and the property prices go up because everyone wants to buy a particular house. That is basically too much demand for property at this point, and that leads to a demand pull inflation. Right? Or else it wouldn't go up. The property price would still be the same. But there are a lot of people who have a lot of money and they all want to buy a particular property or in a particular area. The inflation of that area goes up, and that's because of demand. Now, if you look at the green part, which is more of cost push inflation, if you see in the world, suddenly oil prices might go up. If oil prices go up, there are a lot of industries that depend on oil prices to perform. Now, if oil prices go up, obviously the cost of doing business will go up because now power and fuel becomes more expensive. So higher cost of doing a business. Now, if higher cost of doing a business, by the time I finish my final product, because the oil prices went up, my prices of my final product also goes up, right? And because of that, it leads to a cost push inflation risk. Now, these are the two main things that happen. Now, let's look at something known as domestic inflation. Now, you understood what is demand pull and cost push. Now, let's look at how domestic inflation correlates with the stock market, how domestic inflation and stock market looks like with respect to each other. Now, have a look at the inflation index of India over the last few years in this chart. Now, what you will observe that in the last 20 years, if you can see, the most inflation period that happened was between 2004 to 2010. Look at that entire jump that happened, right? But in the last few years, it has been at around 4ish. What they're predicting is in the next few years, it'll be around 4ish%. But in 2020, it was at 6.2%. But usually, most of the time, inflation in India is anywhere between 4 to 6%. Now, why am I talking about inflation and why am I telling you it's so important? Because when you start investing in the stock market, this is where inflation plays, right? A lot of people, when they invest in the stock market, they get 12% returns, 13% returns, and they're very happy. No one adds into the cost of inflation because whatever you're trying to buy now might be more expensive by 6%. Now, inflation is basically a double-edged sword. That means it has two impacts in the stock market. It has a positive impact, but also has a negative impact. Now, let me explain what the positive impact of actually looking at inflation. Now, when inflation goes up, okay, inflation basically has a nice positive effect on cyclical stocks. Okay, cyclical stocks are those stocks that tend to do well when the economy is growing and tend to do bad when the economy is falling. Very simple. Now, usually, high inflation periods are usually seen when the country's economy is growing, right? When the economy is growing, that means everyone's spending a lot of money, demand goes up, and slowly inflation goes up at the same time. So what happens is if the inflation goes up, then the cost of some commodity stocks will automatically go up because of inflation, because demand is high. So if the commodity stocks go up, or if the commodity actually price goes up of the commodity, all the commodity stocks will automatically start doing well. Right, because the price of that particular good, which was at say 100 rupees, now becomes 120 rupees only because of inflation. And what happens is they get more amount of money in their cash flow. So it is positive. Inflation is actually positive when it comes to high growth of the economy, and also works well with commodity stocks that are cyclical stocks. Now, let's look at the negative effect, which is the opposite effect. Now, inflation can sometimes, for companies, as we mentioned in one of those examples, inflation can sometimes play a role in increasing the price of the raw materials that are there in a particular product. Now, if I'm creating a particular product, maybe the raw material price went up because of inflation. Nothing else. It just went up because of inflation. Now, if the price of the raw material goes up, I still have to maintain my profit margin. So I might increase the cost of my final product a little bit more. And if I increase that, I have to put it back to the customer. Now, the customer might think this is too expensive. So when that happens, it might have a negative impact on the cash flows of a particular company. So that is from a negative impact. Now, there is a third negative impact, and this is very important. Please understand this. There is a third negative impact that in inflationary periods are usually accompanied with something known as interest rates, and it's usually accompanied with increased interest rates. Now, let me tell you how this works. Now, basically RBI, okay, this is done by RBI, where they increase the interest rate to prevent inflation from rising more. Okay, now I'll tell you how this works and why they do it. Now, when interest rate goes up, okay, automatically investors want more returns from the stock market. Now, what is interest rate? Now, I'll tell you what. If the inflation currently, let's assume for an example, inflation of this year is 10%, okay, but your interest rate is currently at 6%. Okay, interest rate means, assume I'm investing in a fixed deposit, and fixed deposit is giving me 6%, but my inflation is 10%. Won't you lose money at that point? Right? Because if you kept it in 6%, obviously you will lose 4% at that point. But what I would say is, you know what, let me go invest in the stock market at least to try and beat the inflation of 10%, if the 10% was there. So sometimes what people do, or what RBI basically does, is that they try to increase the interest rate. Now, the rise in interest rate on debt instruments basically means that investors want more return from equity markets. So if the interest rate goes up, say for example, fixed deposit now gives you 8% returns, then you'll be like, okay, if interest rate of fixed deposit is 8%, then stock market should now give me at least 12 to 13% because it's more risky. So whenever interest rate goes up, people automatically expect the stock market to give more in return. And if that does not happen, they remove their money from the stock market and put it in the safest instrument and still get 8% return and still beat the inflation at the same time. So that is how RBI plays a lot to curb the inflation. Now, if you look at this, right, from this perspective, this is very, very, very important. And I'll tell you why this is so important is because interest rates are extremely crucial when it comes to how the market reacts to it. Because if the interest rates are not attractive, if fixed deposits or debt instruments are not attractive, then all the people want to invest in the stock market to get better returns. But tomorrow, if suddenly the interest rate becomes very attractive, then I would not want to be investing in the stock market. I would remove all my money from the stock market and start investing in a safe, risk-free rate of return from these fixed deposits at maybe 8% or 9% if it ever goes up, if RBI ever pushes it up. But if RBI keeps it low, then everyone starts investing in the stock market. So that's why I said it's very important, because if the interest rates go up and the safety net for fixed deposits go up, then a lot of people will remove their money from the stock market. And if they remove the money from the stock market will fall. That is what happens. So you need to understand, when there are high inflation periods, that is why everyone keeps looking at what is the RBI changing the interest rate, or is the Fed changing the interest rate. Now, who's Fed, right? Let me come to that as well. Now, let me tell you how global inflation, not India. This is what I spoke about India. Let me tell you how global inflation and the stock market have something in common. That is why whenever the Fed rates, I don't know whether you have heard of this, but we know in the news, whenever we see that the Fed might increase the interest rates, we're all glued to our television to see if they're increasing or they leave it unchanged. I'll tell you why that happens. Now, first understand how printing of money works and why it affects inflation. Now, if you look at all the top countries in the world or top economies in the world, right, they have resorted to this thing known as monetary easing, okay, or printing of money since the last financial crisis of 2008. And now what happens when more money comes into the hand of people? The demand for a lot of goods will go up, right? Suddenly everyone has a lot of money to spend. Demand will go up constantly, and if demand goes up, it creates a demand inflation risk, right? That is something that might happen. Now, the main problem with something like this is that immediately after a particular time, if a lot of money is printed into the system and a lot of people have more money in their hands, it causes a high risk for surge in inflation immediately after a particular time. So you'll suddenly see, whenever there's a lot of money pumped into the system, there is a high possibility that you will see a high inflation rate coming soon. Right now, if high inflation rate happens, what did we say? Right? Interest rate comes into the picture. Now, if inflation in these countries go up too much, it might lead to interest rates. If inflation goes up too much, interest rate might go up as well, right? Because people want everyone to start investing and holding their money in that fixed deposit. Now, why US comes into the picture, or why Fed is so important. Now, if there is an inflation in US which is growing fast, then the US Fed has no other option but to increase the rates. Now, why is this such a big issue for us, right? We would keep saying, why are we looking at that? How does that affect us, right? Now, if that happens, if US increases their interest rate, which is completely risk-free and safe, then what happens is a lot of foreign investors who are not investing in US right now are investing in different other countries. All these foreign institutional investors, big people with a lot of money, might just say, you know what, why am I risking so much and investing in another country for 10% return when maybe US has just given me a risk-free rate of return of 8% or something like that, right? So whenever there's a risk-free asset or whenever it is safe, a lot of people might remove their money from the stock market. And recently in December 2020, FIIs, foreign institutional investors, had 21.7% stake in all the companies listed on NSE. Okay, their entire stake, right, is more than the retail investors or domestic mutual funds in India. So the amount of money that the foreign investors are investing in India is massive. So if FIIs decide to exit and say, I think USA is better for me, then the selling pressure can drive the stock prices completely down. So this is something that happens. And if they remove the money, then a lot of Indian investors will start panicking. A lot of local, DIIs and the retail investors will start panicking, which will push the price down even more. So now you understood how inflation, first, you understood how putting more money into the system makes inflation come into the picture. And if inflation comes into the picture, how interest rates might go up, and how if interest rates go up, then it might directly affect the stock market. See how you're connecting the dots? So now every time you look at more money being printed, you should be well aware that is it causing inflation. Next step, you look at inflation. You'll be like, oh my God, the inflation has gone up. That means there's a high possibility that RBI or the Fed might increase the interest rate. And if that happens, a lot of people might remove their money from the stock market. And if that happens, the stock market will go down and all your portfolio savings might go down slightly. So that is why it is very important to understand how inflation works. Wasn't that amazing? Did you now understand how inflation works? And do you know why inflation is so important when it comes to stock market investing? So every time, if you're investing in something, if you're investing in any financial instrument, always consider inflation. right? If you're saying I'm investing in a particular thing that, financial instrument and getting only 4% return, but inflation on that year is 6%, you have actually lost 2% because your currency has depreciated by that much. So always make sure that whenever you're investing in something, understand how investment works, understand how finance works. Everything in the financial world is connected, and that is why we are educating you to understand how a small thing like inflation, or maybe how somewhere in some other country is printing a lot of money, might affect you sitting in India. Right? So this is what we strive to give out as education, and I hope you guys like this. I hope I could explain this in a very simplified format for you guys. And if you liked it, as usual, please like, share, subscribe, and leave a comment below because I like reading the comments as well. And this is me, Shashank Oduppa, signing off for today.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.